And joining me now is Jason Horn from Steyn Capital Management to share his analysis on the day's market's performance. Jason, thanks so much for your time this afternoon. So D-Day around the corner, and many nations are scrambling to, of course, reach a trade deal with the US. The latest to reach an agreement is South Korea, just like Japan and the EU, the Asian nation sitting with a tariff of 15%. We're moving away from that 10% baseline most analysts had priced in. Are you starting to now price in a higher baseline? Looking at some of the deals that have been reached, those tariffs range from 15% to 20%.
Yes, absolutely. I think if we take a step back and look at which call them trading blocks have got these so-called deals over the line, the likes of EU, Japan, and now South Korea, I guess you could argue that those would be the countries or trading bloc in the EU's case that will get the best deals, which kind of sets the new tariff floor at 15%. Obviously, this isn't across all products. Like some precious metals and stuff are exempt, but yes, absolutely, this is the new floor by the look of it.
And the Fed, in the meantime, also making headlines, leaving rates unchanged. This was expected. What was interesting to see, though, was that markets are now lowering their expectations when it comes to a September rate cut. Are you in the same camp? Has Powell's commentary made you less optimistic about rate cuts in the third quarter?
Yeah, I think myself, actually, I've been of the view that it's very difficult for the Fed, as I've mentioned before on the show, to cut rates at this point, given their dual mandate. Look, I mean, we've seen dissent now from two members of the FOMC. I think this is the first time since 1993 that this has happened. So from an overall statement point of view, it was fairly dovish in that regard. However, listening to Powell's conference thereafter, he was quite hawkish. And the reality is, yes, the labor market and the economy might be slowing here and there at the margin, but given the Fed's dual mandate, inflation is looking to continue to increase. I mean, we've got core PCE and jobless claims coming out later. Markets expecting hotter prints, which the Fed has seen already. And that's probably what's fed through into Powell's press conference last night. So, yeah, we are of the view that September may happen, but probably further towards the end of the year for only one rate cut.
And sticking with monetary policy, the SARB also in focus today with expectations of a 25 basis point cut. Are you also pricing that in, considering that we haven't sealed a deal with the US as yet, and the impact of that 30% tariff could have on the economy, have on the rand? And I must just correct, I mentioned that the rand was at 17.10. It's actually at 18. So it's crossed that 18 rand mark. Are you concerned about that? Because surely those are going to be factors on Governor Lesetja Kganyago's mind when, making this decision this afternoon.
Yes, absolutely. And the governor has mentioned several times about trade uncertainty, almost trying to anchor towards this 3% CPI level we are at currently. However, the reality is that, yes, there might be a bit of an impact on the export sector, but South Africa is struggling to grow. The mandate for the SARB is up to 4.5% on CPI, and given how weak the economy is currently, that is disinflationary as well. So I am in the camp of a 25 basis point rate cut. There is room for more than that throughout the year. But I think at this stage, yes, it's probably likely we will get that 25 basis point rate cut today.
And I think it was Goldman Sachs that said they're pricing in a cut at every other meeting that's left for the year. And trust me, that will be a relief for consumers. Let's move over to the earnings scene. Earnings season really heating up over in the US and EU, and focusing on the tech companies. Microsoft and Meta out with numbers overnight. The cloud business giving Microsoft a boost, and ad revenue lifting Meta. Both groups also reaffirming their focus on AI. Walk me through your analysis of those numbers.
Yeah, absolutely. I think if we start with Microsoft, well, I guess both companies, there were some fairly bullish estimates out there, and being able to beat expectations. To your point on Microsoft, investors are applauding this acceleration in growth in the cloud computing unit, and in particular Azure being up 39% year on year. And yeah, they're looking to spend more than $30 billion in the current quarter to build out data centers. So they're really on the front foot in that regard. And then if we look at Meta, very interesting. Mr. Zuckerberg seems to be poaching developers left,
Yep.
right, and center on the AI front, and it seems to be paying dividends. I mean, if we look at what they've been able to do on the ad revenue side, using AI to actually increase ad revenue by about 10-11% year on year, which they are now looking to take advantage of that by saying, look, AI for them is generating revenue now and starting to become profitable, and they're looking to take that and continue this capex build out, which does seem to be a race between the big tech companies to who can get to that scale first.
And talking about capex for a bit, are the concerns around big spending when it comes to AI just fizzling out? I mean, remember at the beginning of the year, we had the resurgence of DeepSeek, and capex was under the spotlight, and a lot of these tech companies were being beaten on the back of that high bill, the high amount of investments they've been making in AI. Are we starting to see returns? And so analysts, investors are more calm about, those spending habits coming through.
Yeah, I think all the spending does add some near-term risks to the bottom line, and that is the big question. Can these companies actually monetize that, and can they generate some profit from it? But yeah, Meta looks to be the clear winner in the AI space over the longer term, according to some analysts, and we can actually see how they are utilizing that AI on the ad revenue. But yes, it is certainly a risk. And yeah, I mean, most of these companies are trading at really, really lofty valuations. So execution risk is definitely there. And yeah, the capex spend isn't slowing down. It's only accelerating at this point.
All right, let's move on to a different sector. AB InBev also making headlines today. The shares being beaten down close to 9%. This, of course, as it reported slowing beer sales volumes, with pressure being felt in Brazil and China. A similar story was also playing out in Heineken's numbers. Does this just speak to shifts in market dynamics, and perhaps the brewers have to now start considering different drinks for different regions?
Yes, absolutely. It does seem to be the case. I mean, on the face of it, kind of ignoring the volumes, I mean, results look okay and ahead of expectations. I mean, if you look at it on an EBITDA basis, they continue to benefit from these efficiencies following the SKU rationalization. But yeah, investors aren't focused on that. It is this big question around the brewers: can they continue and sustain volume growth? And that does appear to be challenging, and each market is different, with the various generations preferring other drinks over beer.
Yeah, I mean, at face value, you'd be like, no ways, this is a lie, because you watch all these sporting events and all you see is chugs and chugs of beer in the audience. But clearly, different markets like different things. Let's move over to British American Tobacco, making gains amid higher demand for its smokeless products. A tough industry, as the group has also had to navigate consumer preferences, consumer shifts as well.
Yes, and I think the real thing here with BTI is looking at the market turnaround in the US operations in particular. One mustn't forget that is the largest profit contributor, and they have strong pricing power in the market. So while APAC and the Middle East and Africa might have been slightly softer versus the US, the investors really are liking that turnaround, where there has been a bit of a struggle in the US, and at the same time, investors are liking the attractive dividend as well.
All right, let's hit pause on the conversation, Jason. Let's take a moment now to touch on what counters your industry peers are watching closely.
I don't like the man, but I like the business. And I think the fact that he's spending so much money stealing Apple's people, and he's just bent on being the leader in AI, I've got to give him credit. And listen, it's up 20% this year. I think the results are coming out this evening. I think he's going to be one of the winners and one of the leaders in AI. Simply, he's that kind of character. And he's got the right products to do it. So I haven't held them. I haven't had them in portfolios. But I think maybe it's time to look at Mr. Zuckerberg.
Okay.
He-Man, he's a Trump acolyte.
The forward PE currently trading about, let's call it 17 times. If you look at the past 5 years, it's trading at an average PE of around about 19 times. So it's definitely not expensive, cheap, and doing the right thing, Simon. It's when you look around, you just keep on seeing these 60 scooters, and you can see that pet business are doing well. Everything is just a well-oiled machine, and it's always been a quality company. I always wanted to get into it, and at these levels, I do think it's looking attractive.
So we did touch on Meta, but I'd like to get your opinion around the talent wars we are seeing, and how far in the race, in the line, is Apple? It does seem like a lot of investors are downbeat about its efforts when it comes to AI in particular. Then we can get your thoughts around the investment case for Shoprite.
Yeah, so I guess the issue for Apple, yes, AI has been it seems like they've been left quite far behind. I know that surrounding Siri and that has been an issue, and investors have been very disappointed around that. Look, they're sitting on a huge cash pile, but I think their focus at the moment is kind of seeing how the tariff wars are going to impact supply chains. Because the reality is iPhones aren't manufactured in the US. That's why when you buy an Apple product, it says designed in California. It is not made in California. So that is a bit of an overhang on the stock. And yeah, I think just touching on Shoprite, the reality is any discussion on retail in South Africa should begin with Shoprite. They're executing incredibly well, and it seems quarter on quarter they keep taking market share from other competitors in the space.
All right, let's get your stock pick. What are you hanging your hat on today?
Piraeus Port Authority, listed in Greece. Piraeus is the fourth largest port in Europe. It's uniquely positioned on the Eastern Med, and it does have deep water capacity and rail links to Eastern Europe. It trades at under 10 times earnings, and it's benefiting from regional growth. I mean, we as a manager like ports, especially those with strong locations. They have local monopoly-like characteristics, and it's difficult to replicate or compete with. So very, very interesting stock.
All right, Jason, thanks so much for your time and taking us through trade at midday. Now, that was Jason Horn from Steyn Capital Management.